I would like to welcome three guests, which we have. The first guest, we start with ladies. Kim is from WeWork Labs. Kim van Halen. She works with startups in the UK, and they have many startups. So we'll hear her thoughts on how their startups are getting investor ready. We have David Wilby. David is a partner at Lewis Silken. David, welcome. And we have Derek Gallagher. Derek is a VP at Global Shares. So welcome, all three of you. And
thank you.
Let's start with Kim. Kim, you organize quite a few investor pitches, and you can see the patterns on which startups get funded, which startups don't. What do you first see as the key pitfalls you see your startups or mistakes your startups do, which if they fix it, they can then go ahead and be successful at fundraising?
Thank you, Martin. I think that's a super important question. So we've done now, I think, 5 quarterly demo nights with around between 100 and 200 startups each. So they're quite big. What usually becomes very apparent is that those startups who, and I think a lot of accelerators make that mistake actually, they try to mold, put all the startups into the same mold. So they lose the authenticity. And that very quickly becomes very boring. So it's especially in such a big investor demo day, you have to stand out in some shape or form. So we very often see that the startups who do in some shape or form are able to get across some part of their uniqueness or their personality are usually the ones who get the most interest. And it's also something that's quite easy to fix, in my opinion.
Okay. David, once startups get investor ready, then they usually speak to you a little bit early on, and then you help them with the legal work and with the paperwork. What do you see as the most common pitfalls startups do, or ways how they do it unnecessarily difficult for themselves?
Yeah, I mean, if I could give people one thing to take away, the top one, and there are various things, is learn to speak the language. Like you go into investment and people will throw around terms like dilution and drags and, you know, pre's and posts and yeah, dilution is my favorite one. I've had 3 different discussions today about dilution with people at various different stages asking various different questions. And, you know, your investor will expect you to know what that means. And it's not difficult to find out. But I think, you know, people sort of expect that as soon as you go and become a founder of a startup, that you just magically know all that stuff. And that's just not really how it works. So, you know, take some time, do it a few months, 6 months even before you're actually going to go and look for funding, and go and learn what all of these things mean. Plug yourself into a community like Kim's that will help you learn these things, or look on the internet. You know, there are great books and resources out there. I've written some blog articles a long time ago now that went up on the Startup Grind blog. So, you know, there's various ways to do it. But yeah, that would be my number one.
Talking about dilution, Derek, you are from Global Shares, which actually helps startups with cap table management. And I see many startups get surprised, you know, when they start introducing, for example, stock option pool, that many of the investors get diluted, and those startups at the beginning did not assume this is going to happen. What do you see from your perspective as some of the mistakes which companies do, which you help them solve?
So I think maybe if I can start by going back to Kim's piece first of all, right? Because we've all heard this analogy that like a startup looking for funding is basically like looking for a husband or a wife. So you got to start out with a bit of chemistry first of all. And I think that's what Kim's talked about. You've got to start out with that little spark that gets somebody interested. But then, as David said, as that relationship develops, people expect more of you. They're going to expect that you know what you're talking about, not just your product, not just the customers that you're going after, but your business, because those investors are not just investing in the product or the team, they're effectively investing in the business. And the way that happens is through the shares that they purchase, whether it's through convertible instruments or straight equity, and how that sits then on your cap table. So I think getting that understanding of what a cap table is, it's just that simple first step. Because when we speak to second-time founders, they know what cap tables are and they know why they're important. When we speak to first-time founders, it's quite often not the case, but obviously somewhere along the journey that becomes something that they have to learn about. So it's better to not learn about it the hard way and educate yourself ahead of time.
Yes, Kim, how do you normally keep track of the weaknesses of startups? How do you help them solve that? Do you just tell them verbally, or you have like a list of tasks which they need to go through until they make it, or it's very simple? As soon as they get funding, you know that they're ready.
It's a good question, actually. I firmly believe in the Y Combinator model, that you don't tell startups, especially founders, what to do, but you help them figure out what they should do, right? We don't have a list. We do work with our companies through stages. So often when they come in, they are in pre-launch or validation stage, and our goal is to get them to early growth, high growth. And that might come with funding. Some make it without having to fundraise, right? Which is a great situation to be in. So we do a lot through office hours and mentoring, right? So ahead of those demo days, though, we do get through a specific checklist. We call it our investor readiness module. So we help with the pitch decks and the pitches itself. But again, not with the aim to fit them all into the same mold, but rather just to help them highlight what's unique about their companies and what are their strong points, and iron out the areas they still need help with.
That makes sense as an approach, if you don't mind me jumping in, Marion. There are certain things which are fundamental, and I think Derek's addressing one of those, right? Your cap table, that's common to absolutely everybody, and having that understood is perfectly right. But to Kim's point, you could have a checklist, but you would be skipping over whole sections for various categories of startup because it just wouldn't be relevant to them. So, the one that I always come back to is, how do you deal with your intellectual property? Everybody's got something, whether it's a brand name or a logo or whatever it is. But for some people, that's the family silver, right? That's our secret algorithm that we absolutely need to have brilliantly protected with confidentiality or whatever else we're going to do, to protect it. Whereas for other people, well, it's my brand name. And yeah, I love my brand name, but if I have to change it, I have to change it. So where you're going to spend your time and energy, where you're going to spend your budget, there are certain fundamentals like your cap table, but outside of that, you've got to fit it to exactly what the company does.
And yeah, if I can, David, I think one of the things, so in a former life, like Kim, I've run an accelerator program, and what amazed me was the amount of companies that come out of the accelerator with a different management team than they went in. And one of the things that, and Kim and David, you can speak to this better than I can, but one of the things that became really clear was that this mistake of startups having, two or three founders is fine. Like there's multiple arguments, should it be 2, 3, 4, but aside from that, but actually issuing equity to them up front and those founders owning that equity straight out is a real problem. And what happens is one founder leaves throughout this, whether it's an accelerator program or just over the first year or two, and they walk out the door with 15 or 20% equity. And then an investor comes in the door and they're looking to invest $500,000 or $1 million, and you're asking them for that for 15 or 20% equity. And they're saying, well, look, you've got somebody who's just walked out the door and they've got 15 or 20% equity and they're adding nothing. So one of the things that's really important across the board is for founders, the founding team, to vest their ownership.
And vesting founder ownership, are there any specifics or any areas which David, you would recommend as a default? Like most companies vest over a period of 3 or 4 years. Do you recommend to be vesting for all the founders, or just not the primary ones? What are recommendations here?
Yeah, well, it depends who's asking, Marion. I mean, to be sort of candid, that the hardest thing to do in the very, very early stages is set a trigger. So what do I mean by that? Everybody understands what vesting is, right? Vesting is, as long as you're still with the business, you keep your shares. If you leave, you give them back, right? Everybody gets that. And later on, when you've got, you know, employees and they've got employment agreements and it's very clear whether or not that agreement is still running or they've left, that's easy. If you've got 3 founders, sure, possibly one of them's going to throw up their hands and say, I quit and walk away. And then you know, okay, well, Bob's left. So, you know, that triggers the vesting clawback. But what if Bob's just not pulling his weight? You know, if you've got 3 people and 2 of them think that the third one isn't doing it, should they be able to say, well, we're triggering your vesting now and we're going to give your, you know, we're going to take your shares back? Or actually, does that leave you too open to, you know, interpersonal dynamics and that sort of thing all cropping up? There is a school of thought that says, well, look, if 2 want to go forward and ditch one, that's probably how it should work in a 3-person company. But I'm not sure personally that I think that's quite the right answer. You know, I think there should be some sort of standard. And without an employment agreement in those early stages, as a nice, clear sort of delineation of you don't work here anymore, you know, you don't go here. How do you draw that line? That for me is the hardest question in the early going.
Okay, Kim, do you have an answer? How do you draw the line?
I have no idea, and actually it's quite funny because David, I should have called you yesterday because I was in an office hour with one of my founders exactly this question, right? They were about to, and I'm pretty sure they don't mind me talking about it. So they were about to give an early advisor, who was a high-profile advisor, 30% in equity. I can see David's face. I don't know if everybody can see it, but like it's quite normal, right? Like for us, we go like, wow, that's way too much. Don't do it. Don't go that direction. But for someone who's running their first company, how do you know that other than, you know, having people around you who can advise you? So, Marianne, I don't know the answer. I actually also don't think. Yes, we often hear that it's better to have co-founders and that investors are more interested in teams that have multiple founders. However, a lot of the angel investors and VCs that come in for office hours in WeWork Labs, they don't really mind. Like they also have investments in teams with one founder, as long as they can somehow prove they're able to attract the right people around them, right? Whether that's early employees or advisors. Quite curious to hear Derek's and David's thoughts on that as well.
Okay. Derek, in your experience, once you get companies onboarded and you know they're becoming customers, which by the way it's pretty neat. You know, it's if I remember correctly, it's up to 10 users for free.
Yeah. So
you're making their lives easier. What are some key pains which when customers come to you, which you help them solve?
So look, I think there's a couple of things. I think one is that first of all, like, so there's a couple of people. If you look at who's in the mix, there's the company themselves, there's their legal advisors, and potentially investors, right? So that investor might be an angel investor, it might be an accelerator program, or it might be an institutional investor or VC fund. And the first thing that happens is the legal advisors and the investors realize that the companies aren't fully educated in this space. So they have to spend time educating the company. And in some cases that costs the company, that costs them money or potentially credibility. So we obviously, we do a lot of work around educating companies around what they should do. So we have a whole academy section on our website, which allows you to go in and learn, you know, the various bits and pieces. And the reason we have a sort of 0 to 10 shareholders is free model is it's exactly like what Kim's talked about. So if you want to bring companies that are on an accelerator program to an investor ready state, they're not ready to pay for something they don't fully understand yet. So give it to them free, let them, you know, put best practices in place and let them establish that with their accelerator, with their investors, with their legal advisors. And as the firm grows, as the company grows, everybody benefits. So I think really it's just back to that piece. It's education is the first thing, because they have to be able to go and educate themselves, and then just trying to keep this simple, because it can be a very complex space. And we work really, really, really hard at keeping it very simple.
Kim, you must be seeing lots of startups and talking to many of them who are going through this fundraising period. Many of them, in my experience, are very hard to coach, because oftentimes they are, while being stubborn is a good thing for entrepreneurs, but being too stubborn is not. Where do you draw the line? Or where do you invest your time when it comes to advising these startups? Because sometimes, or oftentimes, it might be a wasted energy on advising founder who doesn't listen.
Absolutely.
How do you deal with this?
It's absolutely true. I think being coachable might be, or at least being humble might be the most important characteristic we look for, but also we know investors are usually attracted to, right? In the end, we are not a kindergarten or we're not babysitters, right? So if a founder decides that they don't want advice or they don't need mentorship, that's completely up to them. They might benefit in other ways, right? They might like to sit around other entrepreneurs and have the occasional beer. That's fine. However, the ones that are really progressing the fastest are always the ones who are both asking for help in a various different way, but also giving back. We have some very successful founders in labs who perhaps this is their fourth company. They really don't need me to explain the cap table to them, right? Or they really don't need us to help them make their first hires. However, they are still, the most successful ones are still coachable, even though perhaps this guy, for example, has been VP at Rolls-Royce for years and ran their venture arm, right? So yeah,
it's true. It's true. David, you get to see a lot of startups, not just at Startup Grind events, but it's your job to advise startups and help them with the legal work. You're also kind enough to offer to speak to startups on our events while listening to what the issues are. Where do you draw the line in terms of which founders are the real deal and which founders are not really serious about building a company?
It's so hard, isn't it? Because any rule that you set for yourself, you can immediately think of an exception, right? So I know people who will say, well, anybody who's just doing it part-time and hasn't quit their job to go and run the company, they're not serious. But actually, I've got clients who started off that way.
I disagree with that.
Right, absolutely.
Disagree with that.
There's people like the number of founders on the team. So I think my short answer is I don't think there's any rule. I think there's lots of founders from all walks of life and in all different sorts of situations. Some of them have worked in industry for 20 years and decided to go and do a startup now. And again, a lot of people saying, well, they're big business, they're not going to know how to start up. Completely disagree. I don't think that works as a rule either. I'm sorry. I'd love it if there was a snappy answer, but I don't think there is. I think what you do, and it goes back to I think Kim's first remark was, you find somebody who's sort of passionate about a thing, and I think you generally, once you've been speaking to them for a while about what their business idea is, you can see the people who are genuinely doing this because they've got a spark for it. And you can see the people who are doing this because, there's a lot of people who are out there at the moment doing video conferencing for X, right? Because suddenly we're all stuck at home. Now, some of those people are really passionate about video conferencing for X because being stuck in this situation, they've discovered, hey, here's a pain point that I didn't know existed. I think I can solve it. Some of those people are just doing it because they figure that's a startup that's going to get funded in Q4. So, you can see which ones are in it for the long haul and which ones aren't once you've spoken to people for a while.
And David, like I've seen some, you see different things, right? You see people who have a real clarity on what they're trying to achieve, and you just know they're going to do it. You see other people who you just know they're going to work through whatever obstacles come their way, and then you've got people who are just able to attract good people to them. But maybe Kim, if I can ask you a question, I've in all the companies and the demo days and the programs you've run, you must see a lot of people that just don't come back. When they start hearing that direct feedback, that they're just not cut out to take it on board and just don't come back.
With don't come back, what do you mean? Like give up?
Well, yeah. Well, I think in the very early stages, I think you see some people who are interested in the startup space for the buzz of it and the excitement that goes with it. But when it starts getting real, they potentially haven't realized, what's involved. And as you said, how coachable they need to be.
I think we don't have many of those because so WeWork Labs is a paid program, as in you just pay for the WeWork desk kind of, right? So we don't take equity. First I was like, who's gonna pay for an accelerator? But it turned out that actually the teams who come out of other accelerators, for example, for Techstars, they are still small enough that they are not just gonna sit in some private office just by themselves. They still need people around them, right? So we actually have very few of those. Sometimes the feedback is very harsh, right? We do these polls live in front of 200, 300 investors where we ask them out of this vertical, which one was your favorite? There's never a clear favorite, by the way. There's always a lot of, there's always a few that are catching that, but sometimes people get 0 votes. I don't think anyone has ever dropped out after that. Like it usually, yes, it can be super frustrating, but then there's luckily a lot of others who are going through the same pit, and it's an opportunity to improve, right? So I don't know, maybe maybe it's just I don't know. Interesting point though.
Derek, you said you used to work at an accelerator before. Mm-hmm. And you saw founders, entrepreneurs, evolve the idea. How much do you normally have the idea evolve until they become really investor ready? Because sometimes, we see lots of founders who are at the very early stage, they try to please investors too much. And I noticed that oftentimes investors don't like it because they ask these questions just to double check how convinced they are, how much passion they have. In your experience, how much do you think founders should be flexible about their idea of what they want to achieve, as opposed to trying to please investors too much?
Yeah, and it's one of those things that it depends. It really depends on the audience and who you're speaking with. Like those stages when you're really early and you just want money from anywhere. That's when people potentially make the big mistake, and they take in that angel investor who'll write the first 50 grand check, doesn't know the industry, and is going to sort of almost bully them into doing the startup that they want. And I think obviously as you get a bit more traction, you get a bit more confidence, you get a bit more credibility. It's easier to stay where you want. But I think you've got to be very clear. I mean, if you're speaking to an investor who's bringing more than money to the table, they're bringing a lot of experience in the industry. They're bringing contacts. They're bringing they're bringing their network and their experience and potentially other partnerships that they can open up the door to. And they've probably seen some of the mistakes you're going to make. And I think you've got to be, it's back to Kim's point about being coachable, right? You've got to know what your vision is, know what you want to achieve, but you've got to learn who are the people to listen to and who are the people not to listen to. Actually, one of my favorite exercises.
Such a good point, Derek. I love that.
But here's the thing: like one of my favorite exercises with early stage companies is like if you look at all the companies that are out there, the successful people that are out there that you idolize. You first of all have to go through them and figure out what type of company they are. The B2C companies, are the SaaS companies, B2B, what are they? And just ignore the advice from the people that are not the same type of company as you, because their advice is just not going to be relevant. Super cool story and it might be fun, but it may not be relevant to your business and where you want to go.
Can I add to that, just to make it super clear to this audience? Please don't ever try and please investors. Your business exists to solve a customer problem, right? It might be useful to listen to the occasional investor. I mean, Derek, exactly what you say. If they are operating in your industry and they might look for certain metrics that you should probably look to achieve. But I think the only reason you should be flexible in your idea, Marianne, is if it turns out that your current solution doesn't solve the problem for your customer, right? Then you should always be changing, but never to please an investor, please.
David, any other tips which you can think of regarding investors, and especially when they are so far as signing a contract, there are always these fights about the share of equity which founders are happy to offer the investors. How much room do you advise startups to leave for negotiation about the valuation and the share?
Yeah, I mean the rule of thumb is 20%, but genuinely you see a huge amount of variation now. So you do see sort of early pre-seed rounds. I'm seeing 10% and 15% a lot more commonly than I used to. And that sort of 20% round, there is a much greater variation now. I'd say it's in a range of sort of 15, even up to 25. So, you know, around 20, but not necessarily 20. 20 was a sort of hard rule for quite a long time. I think, I mean, you know, the question I often get asked is, how do I set my valuation? And, you know, what can I point to and say, you know, this is why I'm valued at what I'm valued at? And I think that's the wrong question at the early stage. You know, once you get later, there are established ways of doing that. So you're looking at MRR, or you're looking at, you know, whatever the key metric is in the business that you work in. And you can work backwards from that to evaluation. In the very early stage, I mean, basically what you're doing is finding somebody who's willing to buy 15 to 20 to 25%, whatever it's going to be, of your cap table for the amount of money that you need. And that's what determines your valuation, right? So if you need to raise 150 grand, then you can reverse engineer that from, you know, 15% or 20% or whatever it is, and that gives you your valuation. And you just kind of have to plant your flag and say, you know, there's no point in me raising this if you're going to tell me that you need 50% of the company for 150 grand. I might as well just go home, right? So, you know, by sort of, you can point to my revenues, or you can point to my headcount, or, you know, whatever other metric there is, and say, well, your valuation should be lower. But the truth of it is, it's just a commercial negotiation, and it's just, I need to get to a point where I'm giving you a percentage of equity that I'm happy to give you, and you're giving me money that you're happy to give me. And, you know, that's my valuation.
Okay, so we have 1 minute to go. Let me ask each of you for one simple tip, which you would like to leave the audience with. Kim, what would you advise founders to get investor ready?
Honestly, just the same way you try to creep into the mind of your customer and understand what incentivizes them, try to do that for investors. I think understanding what incentivizes them, the time of their fund, those sort of things. Just read Venture Deals. It's a book. I think that's a good place to start.
Okay, Derek?
Yeah, maybe just to pick up on what David said, like the investment amount, the market will set that, but there's other things that will come into play, such as, and certainly at later stages, are you going to set aside an amount of equity for your employees? So definitely later that's going to come in. You can possibly use that earlier as part of your negotiation piece. So just having a look at that, modeling that, getting your cap table clean, I have to say that, but getting your cap table sorted would be the big one.
Okay. David, final thought?
Yeah, just understand what it is that you do, and therefore what aspects of it are important, and, you know, focus your energy, focus your available time and legal spend, or whatever it is that you're going to put into it, on that. Because when you go to your investor and you tell them this is what we do, those are the things they're going to want to see. So make sure that they're up to scratch, put them out first, and then don't worry so much about the other bit.
Very useful. Kim, Derek, David, thank you so much for joining us today. I'm very glad to tell our audience that you're going to join us also for the virtual networking after these next two talks. So looking forward to see you there. And now let's bring on stage our first Fireside Chat speaker.
Great. Thank you so much, Marion. First of all, hello, everybody. My name is Alex. I am a reporter and a bit of an editor at TechCrunch. Very happy to be here. Thanks to Startup Grind, of course, for having Fredrik and myself out. As a general note, I was told we'll be taking some audience Q&A as we go. I know we're dealing with some technical issues, so I don't know where those questions will come up, but we will, of course, try to get to as many of those as possible. And I was going to say, before Fredrik and I got started, that we're dealing with a cross-ocean internet connection, so there could be a little bit of lag in our video, but I don't think that's going to be an issue for the short term. So with all of that throat clearing away, a big welcome to Fredrik Cassel from Creandum. Fredrik, how are you doing?
Alex, thank you so much. Doing very well. And as I mentioned, I mean, very happy to not look at my face on the screen again. So you know, let's hope we can make this work either with or without video.
Yes, well, I think that this sort of get together is a great use of technology during this relatively interesting time, especially here in the US where I am, because we are dealing with rising levels of COVID, whereas I think you all in Europe are doing a bit better. But let's put aside the pandemic for now and talk a little bit about your firm and its most recent fund. I was prepping for our chat today, and I saw that you guys put together, at least if research holds up, a 265 million euro fund back in 2019. And I was just kind of curious about the size of that fund, because it struck me that given your fund track record, your firm track record, you could have raised a multiple of that amount. And so I was kind of hoping you could tell not just myself, but our audience here, why you guys didn't pursue a larger vehicle to make investments for your current fund.
Yeah, I think it's a great question. As I think many of you in the audience know, this is a balance where the trade-off as a venture investor basically is that, you know, the larger the fund gets, the harder it becomes to take really early stage bets and take really early stage risk. And, you know, if we look at the sequence of Creandum funds, they've increased. You know, the first fund way back 20 years ago was 30 or 40 million euros. So this is a significant step up from that. But we've tried always to stay true to what our roots are, which is basically trying to do Series Seed and Series A, and exclusively that, and try to do around 30 investments per fund. And you know, basically, it's always been half seed, half Series A.
Now, I presume the fund size has gone up throughout time because seed and Series A rounds themselves have become larger. So if you'd like to still lead them, you had to have more capital on hand just to pursue the same investment strategy over time.
I think that's absolutely right. And even though maybe the increase hasn't been 10x like our fund sizes, I think, you know, we've also widened the geographic scope. You know, when we started, it was very much a Swedish or a Scandinavian thing, whereas today we cover the entire European continent, and actually even a little bit of the US. So also from that point of view, you know, the number of deals is higher, and as you said, right, the rounds are just in nominal terms bigger.
Yeah. I want to ask one more question about the makeup of your kind of investment vehicle, because I always find these to be very interesting because they explain a lot about a firm's philosophy. You guys, to my knowledge, haven't put together an opportunity fund or a kind of secondary later stage fund. Many firms in the US that I've seen have been doing this just to let them double down on their best deals. I was kind of curious about the philosophy behind keeping yourself to one main vehicle. Is it a focus question? Is it you want to stay true to what you know? Why that choice?
I wish I had like this super punchy answer that, but you're actually you know, it's a very relevant question, and I think maybe just a short anecdote. The question of raising an opportunity fund, I think, comes up for every venture fund manager every 2 or so years, if they haven't already raised one. You know, if they haven't already, it's up for discussion every 18 months. You know, you have this portfolio of fantastic companies, and you feel that you could make use of more money and invest in those winners. And when I last sat down with the folks over at Benchmark in San Francisco, which I actually think run a firm which is in many ways representative of a firm that we'd like to run as well, in terms of focus, sure, and in terms of partnership and in terms of trust, both amongst the people working in the firm, but also between investors and entrepreneurs. Turns out that
Fredrik, I've lost you, sadly.
Yep. Oh, here we go. Here's the video option. Let's see how that works. Yeah. Nice.
You are ahead.
All right. There's Heini as well. Hi, Heini. How are you?
There we go. There we go. Oh, I'm here. Look at me. Hello,
Alex.
I feel like I haven't seen you in several days.
I was just saying, you know, when even the best fund on the planet don't seem to have a real strategy for how they use their pro rata rights, which is what we're talking about here, giving away the upside, potentially giving away the upside of continuing to invest in your winners to others. When even the best fund in the world, which I think it is, really doesn't care so much about it. I felt, okay, maybe this isn't, you know, maybe it's a pretty good strategy to be and keep being very good at what your core strategy is. And for us, that's always meant, focusing on seed and Series A. And I think for the time being, that's where we're going to continue to spend most of our time. And, it's also, we'll get back to this, Alex, but as everyone on this call or webinar knows, it's also an increasingly competitive environment out there. And I think every time spent doing something else than trying to back the best entrepreneurs in the very early stage, it risks diluting and risks basically jeopardizing your chance of winning the best deals.
Yeah, and then in defense of what you guys have chosen to do, it's not like your returns haven't been quite good. You are on your, I believe, 5th fund or something along those lines. So the model has historically worked rather well. And in that, I was doing some research on how you guys approach the market, and I think a partner at the firm, Johan Brenner, said that you guys were, quote, quite agnostic about the industries you focus on. And this struck me as pretty interesting because often we see firms focus on kind of one particular niche in the startup world, one particular type of company. You guys have taken a more broad, almost generalist approach to it. I'm curious if you guys still hold true to that philosophy today, or if you're beginning to specialize more as you pursue an increasingly broad array of startups focusing on so many different things out there.
I think our combination is one which is it's a hybrid. Like there's some we just can't shy away from certain areas or certain sectors of innovation where we feel, we need to lean into this one and build knowledge ahead of the curve and try to be, be aware ourselves of what it is that we're looking for and then go out and actually try to find that. So it's something that we've done historically within certain sectors. We did it early for crypto and Bitcoin. We did it very early for digital health. And for some areas, it's going to continue to be like that. We're going to make initiatives like that, but I think it's never going to take away the basic sentiment in our firm that if someone comes in, like Daniel and Martin did with Spotify back in 2007, and pitched an idea which seemed crazy, and where the consensus was never to put any money at all ever into digital streaming services.
Right.
If we had a too predefined view of the world back then, I think we would never have backed those guys. And maybe the same thing would have applied to Vivino, which you will be talking to later on. So I think there's this, we need to strike this balance where we need to be open-minded and maybe let the best entrepreneur convince us to back even the craziest thing on the one hand. And also on the other hand, when there's sort of mega tech shifts or trends that we really want to get behind, we have the resources now to lean into those and be more proactive.
Gotcha. I think Marion's doing the Vivino chat. I think I'm in the audience for that one, but I want to dig into this idea of non-obvious bets because it's everyone likes to claim that they can go out there and see what other people aren't seeing. So I'm curious, from your firm's perspective, what are the signals that you're looking for in companies that might not fit the current, venture consensus, if you will, that really give you guys the conviction to make either a seed or a check that other firms are kind of backing away from, hiding from, or just not really leaning into as much as you guys have been?
I think we've always been product centric in the sense that, and also like we're a group of 10, 12 investment professionals. So it means that even though the firm has an idea, it comes down to the individual, and we're all different individuals, which I think is a strength. And we like to reinforce that with each and every one of us. Like I love the fact that there are deals that my partners go after that I wouldn't actually spend too much time with. I think is actually a pretty exciting thing. So I think there's a diversity, between the individuals involved. But I think what you'll find in common, which was your question, is we really look for something in the product, some kind of spark that the product has with its users. And with consumer services, that's that oftentimes is pretty obvious. You can see that from even a very small set of data, looking at just 100 or 1,000 users, you can oftentimes see that, like people come back, they engage, they lean into the experience. It's a little bit trickier with early stage, B2B software, even for smaller businesses. But, as the tech stack has evolved, it gets easy also there. But I think if there is a spark, if there's a promise that this company can go somewhere without spending massive amounts on acquisition marketing or massive amounts on building up a sales team day one, there's something else in there. I think the entrepreneur has got our attention.
So I want to talk about the Spark idea. Are you just kind of rebranding the idea of product market fit, or is the Spark that you're searching for something that almost comes before product market fit when the company is even more nascent, and therefore maybe it looks a little bit different than PMF might in a later stage startup?
Also a good question. I think actually the product market fit isn't such a it's not a fantastic concept, because it, in many cases it involves product equals something that can be sold. So in much literature that's been written around product market fit, equates a product with something that can be sold and that someone has paid for, and as soon as someone or many people have paid for it, it
right.
fits the market. And I think that's not perfect. I mean, we for us, if it's about engagement, if it's like we can see that there's engagement, I think we can get over many of the monetization risks. But if we see that there's real engagement, and in some cases that comes much earlier than monetization. So I think where there is engagement, we're excited.
So you're much more interested in, for example, picking TikTok, because everyone's talking about that these days, at least in the US. People open TikTok like 100 times a day. So that's the kind of spark you'd want to see in an early stage consumer application ahead of monetization data. But you want to see people just not being able to get enough of that app or service or product or whatever it is the startup is trying to build.
That is one example. That's one example. And the audience will hear more about Vivino, which is another such example. And Spotify is a third one.
Yep.
There's several of those. And you're right.
Okay, so I want to flip this on its head, because being a firm that has a large focus from crypto to health and to a lot of things that I find very interesting, I'm curious if there are sectors that you just will not invest in. Are there startups or startup types that you just are not interested in as a firm whatsoever? Because I know entrepreneurs are going to be hearing this, and I'm curious, don't waste their time or yours.
Yeah,
where are you not going?
The venture capitalists, just getting the perfect chance to not get deal flow from the audience here. So I'm going to watch my tongue a little bit. But I think
Sure.
it's true that there have been many other firms that have been more ambitious and more successful in investing in pure play e-commerce than Creandum. If it is sort of generalist e-commerce that is based more on out executing others and outbidding others on sort of an acquisition marketing war, I think there have been many other firms that have been more successful and also more active than Creandum. I think that's if there's any field where we haven't really felt so engaged, that's probably one. But that doesn't mean that we haven't invested in things that deal with electronic commerce. Like one of the big winners in a fund not so long ago was a company called Quarter Shop, which basically runs the Instacart model in South and Latin America. Phenomenal business, but that one is more about demand aggregation. It's about providing an interface to users that they love, and also a service and fulfillment and quality on the back of that. That makes the service and the experience something more than sort of Googling for the lowest price of a home appliance.
So listening to you say that there's areas where you're not as focused as a firm, you don't have as many eyes on the ground, but there's no place where you're going to say, absolutely not. There's nothing there that's interested in us and we're going to avoid it entirely.
I don't think so.
Okay.
I don't think so.
No, that's very interesting. I mean, it's a kind of refreshing actually, because many people say, we're only doing vertical SaaS for the next fund. And that's very, mono, it's a little boring to hear. So I'm glad to hear that you're actually thinking relatively broadly. But let's think about the world in two halves. There's roughly B2B focused startups and B2C focused startups. And one thing that happened last year that I was very surprised by was that the balance in kind of global seed rounds switched from B2C to B2B, and B2B rounds became more popular. And in the data that I'm seeing from kind of the US VC scene and the European VC scene, there seems to be a really strong push towards B2B startups. And I'm curious, for Creandum today, are you guys trying to strike a balance between the two kind of main halves of the startup world? Are you more focused on one? Where is your attention more focused on, B2B or B2C?
Great question. I again back to maybe the diversity of the team. I think historically we've been 50-50. It's not been by design at all, not the least. I mean, outside of the design of the team, there hasn't ever been a discussion around, have we done too much of this or too much of that? But coincidentally, maybe, or as reflecting strongest in the small and mid-sized segment of the enterprise community, which is one where we lean in heavily. But we still label that as a business, as the business half, right?
So listening to you say that, it sounds like kind of like SaaS and the ability for sales to go bottom up in organizations has made that sufficiently attractive as to maybe change VC's focus to be a bit more on the B2B side than on the B2C side. Does that mean we can kind of blame Dropbox and their old sales model for what's happened in how much money people are putting into SaaS today?
Yeah, I guess Dropbox has, there are a couple of examples around Dropbox. One is that they did show in the early days that there was a path to market that didn't involve a sales force, but
Yes.
They also showed that, in order to get a real substantial business, you needed a sales force. So I guess it's not exactly I think the message is still that you can get a long way with a product that resonates with users, and you can also get, revenue-wise, you can get a long way with that product. But sooner or later, you will have to excel also in sales and marketing. Perhaps though, that point in time is much later than it was 10 years ago.
I got it. I don't know when we're going to get cut off, so I want to make sure I get to this next question before we're asked to be quiet. I've been talking to a number of seed-focused investors in the U.S. about what's been going on in the pandemic and how that has impacted certain startups' growth rates more than others. And I wanted to hear about what's going on in Europe, which you have a much better eye on than I do. What I'm hearing is that there's kind of like two groups of startups. Those are those that have been accelerated by the trend. By the pandemic, that they're selling remote work tooling or their software is now more in demand, their growth rates are more impressive. And then there's kind of everyone else. And if you're not growing as fast as you were, or you're kind of flatlining, the message that I'm hearing, sad to say, is that VCs are kind of pulling back from those firms entirely. So I'm curious, is there a similar kind of bifurcation of the startup world in Europe as you see it today?
I don't think it is as dramatic or as black and white in Europe. I'm not as tuned into the US landscape, but in Europe it certainly isn't as black and white. I guess there's this fundamental problem. If your business is tanking, it is just incredibly hard to get an outside investor excited. So like there's that, of course. But then I think I think there's been incredible momentum around a lot of businesses who aren't exactly, being pushed ahead by the pandemic situation. Maybe, I think all of them will have a business momentum that's been, if not increasing, at least relatively persistent. But I think there are plenty of those. There are plenty of those across many segments today. So I think, and I think we've seen in Europe, we've seen a lot of good, solid deals being done across the range. Like the way they have managed to localize their offering and the way they're growing in markets where some of the names that we've heard before haven't been so successful is something that really struck a chord with us. So it's not only about understanding the product on sort of on the abstract level, it's understanding what actually does resonate with the Brazilian users or with the Turkish users. And these markets are pretty big. And this also comes back to the team. They are, they're one of the stronger teams that we've come across when it comes to understanding their users, building their next product iterations on data. And the fact that they raised little money before is more an effect of their cost-efficient way of growing their business than anything else.
Yeah, I was very impressed. They raised something like $3.5 million before this round. So they now have more capital than they've ever had before. So I'm curious to see how fast their growth rate can accelerate with this kind of infusion of new capital. It's gonna be a fun one to watch. We've been given 5 more minutes. So I have 2 more questions I want to run past you. Thinking about the entrepreneurs that are going to hear this, I'm very curious to see what your take is on what a Series A deal requires today. And I know every startup is different and every vertical is different, but there were some metrics a couple of years ago that people kept in mind for seed stage companies looking to raise an A. And I'm curious from your perspective, maybe not what metrics per se, but what benchmarks are kind of the de facto standard now in the European scene to raise an A from seed stage?
Yeah, I think you know, the good news for the people on this webinar is that there's more money available than ever before, like literally than ever before, and there are also more flavors of investors around now than ever before. There are investors who are leaning maybe more on sort of a little bit less ambitious. Sorry, not ambitious is the wrong English word, but a less stratospheric ambition for their growth, for the growth of their businesses, and maybe thinking more about sort of preserving capital and being capital efficient. And there's still those that are just looking to max out growth at all costs. And a little bit depending on who you're meeting, it's going to be a little bit of a different reaction to the metrics or to the to the way you describe how your service fits the market. But I think, you know, if we look at a Series A, it's a company that can talk intelligently about their customers and their users. They've used their angel and their seed round to understand what it is that their product brings to users. And these are more than just random users. This is a user group that is slightly more established. Sure. And they've got early signals of ways they can scalably grow that user base or customer base. Series A is still by no means the point where you have proof of scaling. So most of the bets on the go-to-market machinery is still ahead. And I think right. that's held true for the most of my career, 17, 18 years. I still think it's true. Now, what we haven't talked about is, you know, there are pretty big Series A rounds now baked together in companies with no product or with just an embryonic product and like nothing to show for in terms of engagement metrics or these other things that we talked about. And I think that's also a reflection of the European ecosystem being a little bit more mature. There being a little bit more groups of second or third time entrepreneurs that you as an investor can get behind without too many tangible proof points of what it is that they're building. You can actually get behind this team or this group of people building something that's truly amazing. And the leap from investing a lot of money on just a concept has become a little bit less dramatic. It was I mean, for the last 20 years, that's been happening for good teams in the US. And I think we're seeing more of that happening in Europe as well.
How big does a Series A have to be to kind of meet that threshold for you? Are you thinking about like a $15-20 million Series A, or is it more like, you know, 50 on a more nascent product to kind of meet that same category that you're describing?
That's probably a little bit more than just a 50 million round, but certainly if you're raising a Series A of 25 or 30, you're probably sure. in the category where you probably don't always have the metrics justify that kind of amount.
Yeah. I want to squeeze in one last one before I let you go, which is in the current economic environment, many large corporations are still very cash rich and they have large accounts and they're hunting for maybe startup to buy, teams to pick up, that sort of thing. Are you seeing an uptick in M&A interest from larger companies towards your portfolio and other companies in the startup ecosystem around the EU?
I think it's been picking up the last 5 to 10 years. I think the number of companies in Europe that realize that a path to well, just a way to continue to exist is to enrich their innovation base with outside talent. I think that awareness is today so much more prevalent than it was 10 years ago. I think that's always been core to the US ecosystem, and I think it's becoming much more clear in Europe. I do think that the COVID and the pandemic situation has certainly throttled that a bit, but I think in terms of like the general trend, absolutely is there. I think for founders and also for investors, it typically means that instead of a company not doing phenomenally well, instead of getting zero back, you can still make a big buck, like a 3 to 5x, and as an entrepreneur, you can really, you can settle down if you want to with a less even with sort of a medium outcome. And I think that, like, how should we say without sounding, the takers in that segment have just multiplied by many times.
Well, we could go on for another hour. I want to talk about pre-seed. I want to talk about the UK. There's so much to go on, but we have to stop. But Fredrik, thank you very much for your time, and thanks to Startup Grind for having us out. We're going to hand this back now to Marion. But lovely to be here, and I hope everyone does well.
Thanks, Alex. Thanks, Startup Grind.
Okay, so we should be back on. We should be back live. Let's just jump in. Heini, I hope you are here with us.
Yes.
So let's show your video as well, if we can switch it on. And hope we have you. So the audience, well, let me welcome here on our stage the founder of Vivino, Heini. Heini, welcome.
Thank you very much. Very pleased to be here.
Yeah, we are very happy to have you here. It seems like we have people from all over the world. You know, we had Alex from the US. We had Fredrik from Sweden. You are from an island originally. You said Faroe Islands, right?
Yes, that's correct.
And you are now in Denmark.
I'm back in Copenhagen now, yes. I've been based in the San Francisco, Silicon Valley for the past 7 years now.
Heini, I want to start where Alex left off, because I really enjoyed Alex. Alex from TechCrunch, you can tell that he knows his stuff. And the last question he asked Fredrik was about M&A.
Yeah.
Vivino is a project which quickly conquered the wine world. Do you have any M&A offers? So what do you think about the route of going from the founder to an exited founder and just start enjoying life?
Yeah. So first of all, I think he also has a question about what's it been like during the Corona? Has M&A activity gone up and so on? And I think both from a investment point of view, but also M&A, things have gotten really, really hot. A lot of deals are happening right now, both funding, but also, people buying each other and so on. So yes, we've seen increased value there, increased action there. So you said just before that we seem to have conquered the wine world really quickly, and sometimes it looks like that, but it has actually been 10 years. So it always takes a while to get there for sure. But yes, M&A, definitely more activity right now. And for someone like us, we wanted to build an amazing company. We wanted to build a sustainable company. And if that's going to end up with M&A activity or an IPO, but we don't really know that. We just want to build an amazing company.
Yes. So let's start at the beginning then. When Google started to bring a browser to the stage, there were already like 6 or 7 browser companies available on the market. When you launched a Wine app, there were almost 1,000 apps on the App Store.
Yeah. And
yet you won the race. And I would like to dig into the details, because there were, I'm sure others had more ambitions and they had a better starting position. Let's start with the biggest pain you wanted to solve, and what did it take you in those last 10 years? What were the key things which, after you implemented them, brought Vivino more to the world stage of wine? How did it start?
I think it's not something that's easy to do, but it's really not that complicated. Can you or can you not solve the problem? Can you understand exactly what the problem is, focus like crazy on that, and then actually solve the problem? Mm-hmm. And I think we figured out really quickly that the problem that people needed to solve is, this one wine I have in front of me, is it good or is it not so good? Like focus everything on that and nothing else.
And how do you know this is the key problem and not the price of the wine or how to buy other wines? What made you think this is the key issue?
Yeah, I think we asked our users very early on, what do you think is most important? And like the ratings number one, price section number two, and so on. So we knew that pretty well. We could also see as we got better at that, that the user became more and more engaged. So the other problem in this is, which is kind of strange with this particular product, is that wine is extremely long tail, right? So we have 10 million wines. So the day you launch this product, you can't solve problem for everybody. It's just about solving the problem for as many as possible and then keep increasing that. So what we learned early on is, hey, you're not gonna have a perfect product. You're not gonna have an amazing product, and that's fine. Someone like Apple could never build a product like this, right? Because they want to release something that's done and polished. You need a certain mentality of being able to release something that you improve. And what we learned really quickly is not to have a perfect product, but to have the best product. So look at who you're competing with and then focus on having the best product. Doesn't mean it's amazing. In the beginning, we had all kinds of people pounding us with the data was wrong and everything, but you have to keep pushing forward. Focus on having the best product, not the perfect product.
Okay, and you started with knowing what the key issue was, but then you had the issue of anybody who's building a marketplace needs both sides of the table.
Yes.
And in order for users to be attracted to Vivino, they need to find something useful in the app. And when you're starting, there's nothing in the app.
No.
How do you make it to the point that you get the viral effect of users bringing other users?
And that really took us a while, honestly. But really what you do, if there's any way you can hack your way to that, do that. And what we did specifically was, look, we had to have seen the wine before we gave you some information. So, and the fact of the matter is, hey, we hadn't seen most wines, so that was impossible. So what we did is like, hey, we got your label, and then we didn't even crowdsource it. We sent it to India, and then we had people manually looking at that wine label, adding as much data as possible. Then we went back to the user and said, hey, thank you for sending the label. We're looking into it. Like sometimes minutes or 8 hours, we came back to them and said, hey, we've now looked up this wine, and here's what we have. And it's still not amazing, but it's better than nothing. And the user like, you know what? Maybe I'll give them another shot. So it's all about getting as much out of it as you can, and then you build that slowly. And we went on around 18 months without really getting any traction. We just grinded through building the database, focusing. And at some point after around 18 months, things started to take off.
What does it mean in terms of the wine etiquettes? How many wines do you need to be relevant on the market?
Yes, that's a great question. And I've definitely adjusted my perception on that very much. I thought in the beginning, hey, if we get to like 20,000 wines, we'll be fine. But that number just kept going up and up and up. And now we have 200,000 producers and 10 million different wines. And we actually have 1.3 billion pictures of wine labels. And I'm not saying you need that much, but if you don't have 1 million wines and 10,000 wineries, you're not going to go anywhere.
Mm-hmm. Interesting. About 15 years ago, I was working at Orange, and at that time there were rumors going around that Apple is going to come up with some mobile phone, and all of my colleagues were laughing. Because Apple had no expertise in mobile phones, and they did it over and over again. They also, disrupted massively the music market, and not just the players, also the music business model. And when I was doing some research on Vivino and on your background, you are not actually coming from the wine industry. You are coming from the software world. Yeah. And I think this is also something which gives you a fresh perspective of the market, because you were coming as an outsider. How did this perspective help you understand the wine market, and how was your perspective different from the wine insiders?
Yeah, it's a very interesting question, and this is not a first. that someone totally from the outside comes in and it sort of disrupts things, right? So I will say that I actually think it was important. First of all, when we focused on what our users should, who our users should be, we wanted them to be people like us. I mean, people that loved wine, but didn't necessarily want to make it a hobby. Like, we were not going to build an app for people that want to take notes about licorice and earthy taste, whatever. That was not what we're doing. So I think that in itself, our understanding of the user was very strong because we were it. And a lot of our competition was not that. They were, hey, I know wine, I should make a wine app. Actually, you really shouldn't. So it's about understanding the user, and we were that user, and I think that's incredibly important. That's one thing. The other thing I think that's important is that we brought some naivety. So I did speak to a lot of people in the industry, and everyone said the same thing. You know what? I said, hey, I want to build a wine app. I want to build a database of all the wines in the world. Every single wine in the world, it needs to be in them. Everybody in the industry said the same thing. You know what? First of all, you can't do that. You should focus on Bordeaux or something like that. We just came in with and said, no, we're just going to do that. And people were probably polite, okay, interesting, and then they just walked away shaking their head, thinking we're kind of stupid. So I think those things, sort of understanding the actual user and bringing naivety, saying, hey, it's possible. I think those things were very important.
Okay, we have a question here on Slido, and by the way, the audience, feel free to ask any questions if you like. You can go to slido.com/startupgrind and ask away. There's a question here from Antonio, and Antonio wants to know, when are you going live with a non-perfect product? How do you manage the user disappointment or criticism for the early pitfalls?
Yeah. First of all, it's fine. Like, so people say, what about all these users we lose? Yes, you're going to lose 7 users. Who cares? It's not like, we had TechCrunch guy on here. You're probably not going to be on the front page of TechCrunch. You're probably not going to lose that many users. So it's fine. Be humble about it. Say, hey, we're trying to improve our product, and if they see progress, some of them will stay. You'll lose some. So let me give you an example. That something happened for us because one of the things we looked a lot at is match rate. So how many, when people scan 100 wines, how many of them do you actually match? And we found out that when we started, it was maybe 10%. We didn't do anything. We did the rest manually, right? And we came out and said, yeah, we matched around 30%. It wasn't entirely true. But we just kept grinding. And it turned out that when you hit around 70% for us, so 2/3 of the time, at least the product works somewhat. Then the curve started to go up. Before that, you were fighting for every single user. But the thing is, with a product like